Welcome to the Fiscal Philosophy YouTube channel. It's no question that milk, dairy alternatives are here to stay. You see them in every grocery store now, whether it be almond milk, soy milk, or oat milk. And the most well-known brand of oat milk is, in fact, OATLY. I have covered this stock before, and I decided, since it's been a while, to look at the most recent numbers and see if it is finally at a point where I think it's investable. So the stock is still only at about 70 cents per share. So cheap in absolute terms, all right, as in each individual share doesn't cost much. But again, this is a small cap. It looks like, at least for the trailing 12 months, it's not profitable. But let's see where it looks like things are heading, what they've done recently, if the numbers are improving, and if this is potentially worth consideration at this point. First, is it growing? Technically, yes. However, it has slowed down. If you compare, say, the 2023 versus 2024 numbers compared to the kind of growth they did in the years from 2020 to, say, 2021, there's definitely a big slowdown in their revenue growth, but they are technically still growing their revenue. So that's better than if it was staying the same or shrinking. But the question is, can they convert this revenue into any kind of positive cash flow or profitability? So what has contributed in the past to the financial woes of OATLY? Well, their gross margins seemed to have just absolutely cratered in the past. However, the last couple years, they have recovered. They used to be in the low 30s percentage-wise. They crashed very low to almost zero, and then recovered back to the high 20s, 29.8. So they're back to almost 30% gross margins. So I'm sure that's putting some kind of a dent, even with the lack of revenue growth, into the negative, the negative cash flow that they're experiencing. I'm sure that it's gotten a lot closer to where they want it to be. So this chart is the inverse, right? So as their gross margins shrank, their cash flow went more deeply negative. Now, as it has recovered, the free cash flow has gotten closer to break even. However, they still, in the last quarter, burned $26 million in cash. And so this company is not, at the present moment, turning any kind of a profit, whether from a cash flow perspective or from a net income perspective. So at the heart of the issue, I think, is still their SG&A expenses. On their quarterly revenues of just over 200 million, they had 62 million in gross profit. That is, their revenue minus cost of goods sold left them with gross profit on all of the oat milk and whatever that they sold of $62 million. However, they spent more than that in SG&A. All right. And that this is the heart of the issue. If they could sufficiently cut SG&A down to a more reasonable level, even down to like 50 million, they would go slightly positive in terms of free cash flow if this is matched as far as like being a cash expense. So what it comes down to is too much SG&A compared to how much gross profit they actually bring in. And I think that if you're throwing a bunch of money at SG&A and it's not driving your revenues up really well, like really, really well, you need to reconsider that spending, because burning $26 million quarterly in cash just digs your hole deeper, because they have to do one of two things. Either dilute shareholders to raise funds, which down at like 70 cents a share, dilution's probably a bad idea. Now, they could also raise debt, but they've got a pretty good amount of debt, as you're going to see. So what they have is basically a mountain of debt. Now, they've got like $100 and something million in cash, but their debt outweighs their cash by over $370 million, while they are still burning cash every quarter. And in fact, $26 million in the most recent quarter. So this means that they need something big to change to become profitable and to be a value creator for shareholders. Driving back up gross profits a little bit more, maybe getting it to 31, 32%, something like that could definitely help. I mean, more would be better, but I'm trying to be realistic compared to what their best gross profit has shown to be in the last few years. And that seems achievable, that, maybe 31, 32%. But even still, we're only talking about what, $5 or $6 million quarterly in difference by raising their gross profits by that little bit more than what they already have. Now if they did that plus got their SG&A down, I think they could go cash flow positive, but they still have like this mountain of debt to overcome. And then where does the money come to grow? Because it seems like they're not able to push really fast growth anymore on the levels of SG&A that they have right now. And they've spent more in the past, and it didn't really move the needle enough and like help drive, again, shareholder value. So they're stuck in a pretty tough predicament right now, it looks like. Now, I do think they're pretty close. They had in per share terms -4 cents of free cash flow per share, and again, that was negative $26 million total. And I can see where they could get to free cash flow positive, but I don't think there's enough growth there anymore to where it's like putting up enough profitability and overcoming this debt to the point that it makes a super attractive investment. But it's going in a slightly better direction. Like, it's still kind of trending in the positive direction in terms of their margins, and they have somewhat brought down SG&A from past levels. So I probably will just keep looking at this from time to time, and if I see more positive changes, there's a remote chance that I could take a speculative, like, small stake if I thought that they were performing better than I was expecting at this point. But I would really need to see those changes actually come to fruition and see that sign of free cash flow positivity. At the moment, they're still like not really that far off from insolvency if something doesn't continue to improve. So there's still a good amount of risk with this stock, and the fact that they're under $1 per share means they're kind of categorized as like a penny stock and everything like that. So there's sort of a lot of negatives working against them. And I can't imagine that they're getting great interest rates on debt at the moment either. So these are things to keep in mind, ladies and gentlemen. And as far as, valuation or, 12-month price targets, analyst forecasts, and the rest of it, keep in mind, they're talking about $1 or $1.50 per share. And it only takes, I think, a few cents per quarter in positive free cash flow to really justify these price targets. So I'm thinking the analysts are probably more or less assuming that this thing is going to go into the positives of free cash flow. Those gross margins will inch up a little bit. The SG&A might, just come down a bit, and maybe operational expenses will improve somewhat. And if they can turn that positive, then it takes very little to justify the $1 to $1.50 price range that the analysts are talking about in these forecasts. So I can see where they're coming from, but again, this assumes that something else doesn't go wrong while they're still on the way, because they're not there yet. And again, they have considerable debt, and that means that getting disrupted on their way to cash flow positivity could cause them to have to take on even more debt, and then it could be a negative downward spiral very easily. But if they do hit that cash flow positivity level and maintain it for a while, I think you could see the market respond really favorably. So That's where it's at. For me, it's still a pass because I see asymmetric risk at the moment. But should they keep improving things in the right direction, I could actually reconsider later. If you made it to the end, I'd like to thank you very much. Please ensure that you like the video for the algorithm, subscribe to help me grow my channel. Follow me on the X platform at Mr. Macho Mog. Also, catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. My Discord is also linked in the description. It's absolutely free. Comment below if you're into the OATLY stock. Let me know what you think about my assessment of their financials. If there's any positive catalysts or anything I'm missing, I would love for you to tell me more about it down below. Take it easy, everyone. Have a wonderful day.